Welcome back to our deep dive into the Tariff Blitz of 2025. In our last video, we walked through the timeline of events that created some truly unprecedented market volatility. Today, we're switching gears and going full technical analyst mode. We're going to examine exactly how the charts told us the story of fear, panic, and recovery. And here's the kicker. They often gave us these signals before the news even hit the wires. If you're a trader or technical analyst, this period is like a masterclass in reading market sentiment through pure price action, volume, and those key indicators we all watch religiously. So grab your coffee, pull up your charts, and let's decode what the market was really screaming at us during one of the wildest rides in modern financial history. Let's start with election night, November 5th, 2024. Now, if you've been trading for a while, you know that markets absolutely hate uncertainty. And elections. They're uncertainty on steroids. What we saw was a textbook example of how markets react when that uncertainty suddenly gets lifted. The S&P 500 gapped open higher after the election results were announced. And this wasn't just any gap, this was a classic relief rally gap. Here's what was happening under the hood. Before the results came in, the VIX was elevated as traders were pricing in all sorts of potential outcomes. But once we had clarity on who won, that anxiety just evaporated. The VIX dropped to around 16, right back into that comfortable 15-20 range we're used to seeing. Think of it like this: investors had been sitting on the sidelines with cash, waiting to see what would happen. Once the uncertainty was gone, they flooded back into the market. That's your gap opening right there, pure supply and demand economics playing out on the charts. After that initial election rally, the market did what it often does. It needed to digest those gains. From November through January, we saw the S&P trading in a pretty defined range between clear support and resistance levels. Sure, we pushed to new highs initially, but then came the typical year-end profit-taking. You know how it goes: institutional money books profits, retail investors cash out for the holidays, and volume starts to dry up. The market just consolidated, building energy for whatever was coming next. Looking back, this consolidation period was actually setting up the technical foundation for the chaos that would unfold in the spring. Now here's where things get interesting from a technical perspective. When the first tariff announcements hit on February 1st, 2025, the market's initial reaction was pretty muted. In fact, we actually pushed to new highs over the next couple of weeks. But here's what seasoned chart readers were watching. The market was starting to show signs of weakness. By early March, we saw the S&P break below a key support level, and the chart began forming what we call an M-top or double top pattern, one of the most reliable bearish reversal signals in technical analysis. What made this particularly concerning was the failed retest. The market tried to break back above that resistance level but couldn't hold it. That's when smart money started heading for the exits. The consolidation below support was telling us that the bulls were losing control, even before the major policy announcements that would follow. April 2nd, 2025. If you were trading that day, you'll never forget it. This was the day the universal tariff announcement hit, and the technical carnage that followed was absolutely historic. The S&P gapped down hard overnight. We're talking a 3% gap that just kept getting worse. By market close, we were down 4.84%. But that was just day one. The selling continued the next day with another brutal 5.97% drop. Think about that for a second, nearly 11% in 2 days. The fear over that weekend was palpable. You could feel it in every trading forum, every financial news channel, every conversation among traders. But here's what made April 2nd truly extraordinary from a technical standpoint. This triggered what would become known as the worst 2-day loss in U.S. stock market history. The VIX absolutely exploded above 50. We hadn't seen fear levels like that since the darkest days of COVID. When the VIX hits 50, you know you're in full-blown panic territory. Let's talk about the VIX for a moment, because this is where the real story was being told. The VIX peaked at 60.13 during the April crisis. And to put that in perspective, normal market conditions keep the VIX below 20. When it hits 30, we start talking about significant fear in the market. Above 40, that's panic mode. At 60.13, we were in the same company as some of the most traumatic market events in recent history. the 2008 Lehman Brothers collapse, and the initial COVID crash in March 2020. April 7th is when the first critical technical signal appeared, and it happened in the overnight session where most retail traders weren't even watching. The E-mini S&P 500 futures showed a failed bearish breakout pattern during overnight trading. Now, we're not showing this specific chart pattern in today's discussion, but this failure in the overnight futures market was absolutely crucial for anyone who knew how to read it. When you see a bearish breakout that fails to follow through, especially after the kind of selling pressure we'd been experiencing, that's often your first hint that the bears are running out of steam. This is why professional traders monitor the overnight futures sessions so closely. The E-mini futures trade nearly 24 hours a day, and they often reveal important technical developments before the regular session even opens. Smart money was watching this failed breakdown very carefully. April 9th was the day everything changed. The policy pause was announced, and the market's response was absolutely explosive. We saw a massive 9.52% move higher, one of the largest single-day gains in market history. But here's what made this move so significant from a technical perspective. It wasn't just the magnitude of the gain, it was how it validated that failed bearish breakout we saw in the futures market just 2 days earlier. The overnight futures had already been telegraphing that the selling pressure was exhausted. Think about the sequence. April 7th showed us the technical setup with that failed breakdown in the E-mini futures, and April 9th delivered the fundamental catalyst that unleashed the buying power that had been building underneath the surface. This is technical analysis and fundamental analysis working together in perfect harmony. After that dramatic April 9th reversal, the market needed some time to process what had just happened. We saw consolidation over the next few days, which was healthy and expected after such a violent move. Volatility remained elevated as traders were still on edge, but if you were watching the right indicators, you could see the momentum was shifting. Eventually, the market broke through resistance and started moving higher. That's when we knew the character of the market had fundamentally changed. The volatility also began to subside, which was our confirmation that the panic phase was truly behind us. By May, the market had been steadily moving higher following that dramatic April reversal. We were seeing consistent buying interest and a gradual return of confidence among investors. Then came May 12th, the day the US and China reached a trade agreement. The S&P 500 closed up 3.26% that day, but more importantly from a technical perspective, this move pushed the SPX decisively above the key resistance level that had been capping the recovery. This wasn't just another bounce. This was the market breaking through a critical technical barrier, confirming that the previous downtrend was truly over. The VIX also collapsed from those April highs above 60 down to 18, signaling a return to normal market conditions. The fear trade was officially over. The 2025 tariff crisis gave us a masterclass in technical analysis, and there are 3 key lessons every trader should remember. First, bearish chart patterns were forming well before the major meltdown. The S&P had already broken below key support levels before the worst of the selling began. The charts were giving us advance warning if we were paying attention. Second, extreme readings in sentiment indicators like the VIX often mark turning points, not continuation signals. When everyone is terrified, that's often when the best opportunities present themselves. And third, the most dramatic reversals typically come from the most extreme oversold conditions. The April 7th failed bearish breakout didn't happen by accident. It happened because the selling had finally exhausted itself. Technical analysis won't predict the future, but it gives you a framework to navigate even the most volatile periods. The charts reveal the current balance of supply and demand, and in 2025, that balance shifted more dramatically and quickly than we'd seen in decades. The Tariff Blitz of 2025 reminded us why technical analysis remains essential for serious traders and investors. While fundamental analysis might tell you what should happen, technical analysis shows you what is actually happening in real time through price and volume action. The charts captured every single emotion during this period, from election uncertainty to tariff panic to recovery optimism. For those who knew how to read them, the technicals provided both early warnings and recovery signals that news-based analysis completely missed. They reflect the collective wisdom and emotion of the market. In our next video, we'll dive deep into market sentiment and investor psychology during this same period. We'll explore the human side of what these charts were actually measuring. Thanks for watching, and I'll see you in the next one.